Investing is not just about crunching numbers. It's also about understanding the people behind the businesses. These are the people entrusted with your capital. Qualitative factors such as management quality and ethical standards are crucial in assessing the true worth of a company. Many investors primarily focus on quantitative factors like earnings per share and return on equity. While these numbers are important, they only tell part of the story. Qualitative factors provide a more complete picture of a company's long-term prospects. Think of it like this. You wouldn't invest in a ship without knowing the captain's experience. Similarly, you shouldn't invest in a company without understanding its management team. Evaluating qualitative factors can be challenging. It requires careful research and a healthy dose of skepticism. However, it is an essential step in making informed investment decisions. A company's management team is responsible for its strategic direction. They make decisions that impact the company's profitability and growth. Therefore, it is essential to thoroughly evaluate the management team's quality. Start by examining the background and experience of senior management. Look for individuals with a proven track record of success in their respective fields. Consider their education and any relevant industry certifications. Assess whether the management team possesses the necessary skills to run the business effectively. Do they have a deep understanding of the industry and the competitive landscape? Are they adaptable and capable of navigating challenges? A strong management team will have a clear vision for the company's future. They will be able to articulate their strategy and how they plan to achieve their goals. Transparency and open communication with shareholders are also important indicators of good management. Ethical behavior is paramount in business. Investors should be wary of companies with a history of unethical or illegal activities. These can be major red flags. Conduct thorough due diligence to uncover any past scandals or controversies involving the company or its management. Investigate if there are any criminal cases against the company's promoters or senior executives. Look for news articles, legal filings, or regulatory reports that raise concerns about the company's ethical conduct. Pay close attention to any history of accounting irregularities, environmental violations, or product safety issues. A company with a poor ethical track record is a risky investment. Even if the financials look good on paper, ethical lapses can lead to significant financial losses and reputational damage. Section 4. The guardians of good governance, independent directors, and shareholder rights. Corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. Good corporate governance is essential for protecting the interests of shareholders. One crucial aspect of corporate governance is the role of independent directors. These are members of the board of directors who are not employees of the company and do not have any significant business relationships with it. Independent directors provide objective oversight and help to ensure that management acts in the best interests of all shareholders. Investors should examine the composition of the board of directors. Look for a healthy mix of independent and executive directors. A board with a majority of independent directors is generally considered a positive sign. Section 5. Minority shareholders. Are they treated fairly? Minority shareholders are those who own a small percentage of a company's outstanding shares. It is important to ensure that their interests are protected. Unethical management teams may be tempted to take actions that benefit themselves at the expense of minority shareholders. Evaluate how management treats minority shareholders. Do they communicate openly and transparently? Are minority shareholders given a fair opportunity to participate in key decisions? Be wary of companies with a history of related party transactions. These are deals between the company and entities that are connected to its management or major shareholders. While not all related party transactions are unethical, they can raise concerns about potential conflicts of interest. Section 6. Excessive compensation and questionable connections, investigating potential conflicts of interest. Investigate whether the company gives financial favors to known entities. This could include awarding contracts to companies owned by family members of management or providing loans on favorable terms to related parties. Look for any signs of nepotism or cronyism within the company. Assess promoter salaries and compare them to industry averages. Excessively high salaries can be a red flag. Also, evaluate the quality of major shareholders. Are they reputable institutions or individuals with a long-term investment horizon? Investigate the political affiliations of promoters and management. Close ties to political figures can sometimes lead to conflicts of interest. Assess the promoter's lifestyle and public displays of wealth. While not always indicative of wrongdoing, extravagant spending can raise concerns about potential misuse of company